In 2025, gold set 53 all-time price records. Not 5, not 10. 53 separate all-time highs in a single year, the strongest annual performance since the late 1970s. The price surged over 50%. Goldman Sachs is targeting $5,400 per ounce. By the end of 2026, JP Morgan says $6,000 is possible. Morgan Stanley, Citi, BNP Paribas, every major bank in the world raised its gold forecast. And yet most ordinary people are not paying attention. Central banks, the most powerful financial institutions on Earth, bought over 1,000 tons of gold every year from 2022 to 2024. The world's smartest money is quietly moving into gold. And today, Coin Explained is going to tell you exactly why, what gold is, what is driving this historic rally, and what it might mean for your own financial decisions. What is gold, and why has it been valuable for 5,000 years? Before we get to the 2025 gold rush, let's answer the most basic question. What actually makes gold valuable? Gold has been used as money and a store of value for over 5,000 years across almost every civilization on Earth. That is not a coincidence. Gold has a unique combination of properties that make it almost perfectly suited to store value. It does not rust, it does not corrode, it does not decay. A gold coin buried in the ground for 1,000 years looks identical when it comes back out. It is durable in a way that almost no other material is. It is rare, but not impossibly rare. All the gold ever mined in human history would fill roughly 3.5 Olympic swimming pools. That scarcity gives it value without making it so rare that you cannot actually use it. It is divisible. You can cut it into smaller pieces without losing value. It is portable. You can carry significant wealth in a small physical form. And it is universally recognized. Every culture, every country, every era of human history has agreed on its value. For most of human history, gold did not just represent money, it was money. Under the gold standard system that operated in various forms until 1971, the paper money in your pocket was literally backed by a specific amount of gold held in government vaults. You could, in theory, exchange your dollars for actual gold. In 1971, President Nixon ended the gold standard, disconnecting the dollar from gold entirely. From that moment on, the value of money was based entirely on trust in governments and central banks. And as we discussed in the previous videos on this channel, that trust is increasingly being tested. What happened to gold in 2025? 2025 was, by almost any measure, a historic year for gold. The price climbed from around $2,600 per ounce at the start of the year to briefly exceed $4,300 per ounce in October, a gain of over 50% in less than 12 months. Gold demand, including all sources, topped 5,000 tons for the year, a record. Total gold demand reached a record $193 billion in value in Q1 2026 alone. What triggered this? Multiple forces hit at the same time. Global trade tensions and tariffs created economic uncertainty. Geopolitical conflicts, in the Middle East and elsewhere, pushed investors towards safe havens. The US dollar weakened as concerns about American fiscal policy grew. The Federal Reserve's independence was publicly questioned, and underneath all of it, the global debt crisis we explored in the last video made gold's fixed supply nature increasingly attractive compared to currencies that governments can print at will. The World Bank described it as conditions comparable to the 1979-1980 gold surge, the last time geopolitical tension, a weakening dollar, and fiscal instability all collided at once. In 1980, gold surged and then collapsed when conditions stabilized. Whether that pattern repeats is the critical question for 2026 and beyond. What is different this time, according to most analysts, is the structural nature of demand, particularly from one very powerful group of buyers. Why central banks are buying gold at record levels. Here is the part of the gold story that most financial news completely misses. Individual investors come and go. ETF inflows and outflows can reverse quickly. But central banks, the institutions that manage national financial reserves, have been buying gold steadily, consistently, and in record volumes since 2022. From 2022 to 2024, central banks bought more than 1,000 tons of gold every year, more than double their average buying rate from 2015 to 2019. In 2025, even as prices hit records and many retail investors pulled back, central banks still bought 863 tons. In Q1 2026, central bank buying surged again to 243 tons, a 35% increase over the previous quarter. The National Bank of Poland was the largest single buyer for 2 consecutive years. India, China, Turkey, and dozens of emerging market central banks have all been steadily increasing their gold reserves. Why are the world's central banks doing this? The answer connects directly to what we covered in previous videos. The dollar has been the world's reserve currency, the foundation of global trade and finance. But countries are increasingly nervous about having all their reserves in US dollars, particularly after the US froze Russia's dollar reserves following the 2022 Ukraine invasion. Gold cannot be frozen. It cannot be sanctioned. It cannot be printed away. It sits in a vault and holds its value regardless of what any government decides to do. This shift from dollar reserves toward gold is what analysts call de-dollarization. It is happening slowly, but it is happening, and central banks are leading it. What actually drives the gold price? Gold does not pay a dividend. It does not generate profits. It just sits there. So what determines its price? There are 4 main forces that drive gold up or down. The first is real interest rates. When interest rates are high and inflation is low, holding gold is expensive because you miss out on the returns from bonds and savings accounts. When real rates are low or negative, when inflation is eating away at what your savings earn, gold becomes relatively more attractive because at least it holds its value. The second is the strength of the US dollar. Gold is priced in dollars globally. When the dollar weakens, gold becomes cheaper for buyers in other currencies, which increases demand and pushes the price up. When the dollar strengthens, the opposite happens. In 2025, a weakening dollar was one of the key accelerators of the gold rally. The third is fear and uncertainty. Gold has a 5,000-year reputation as the asset people run to when everything else feels unstable. Wars, financial crises, political turmoil, pandemic, all of these historically drive gold demand. In 2025, multiple sources of global uncertainty hit simultaneously. The fourth, and increasingly important, is central bank demand. As we just covered, when the world's largest financial institutions systematically shift their reserves toward gold, it creates a structural floor of demand that does not disappear when sentiment changes. Right now in 2026, Westpac projects gold trading between $4,500 and $5,000 through 2030 as a new baseline. Amundi targets $5,000 by 2028. VanEck sees potential to reach $5,000 per ounce as structural demand and uncertainty continue to grow. Should everyday people own gold? This is the practical question, and the honest answer is nuanced. Gold is not an investment in the traditional sense. It does not grow a business. It does not pay you income. Over very long periods of time, it roughly keeps pace with inflation, meaning it preserves purchasing power rather than dramatically growing it. A stock portfolio or real estate investment over the long run has historically outperformed gold. But gold is not trying to be those things. Gold is insurance. It is the part of a financial plan designed to hold its value when everything else is falling. In 2008, when stock markets collapsed by 50%, gold rose. In 2020, when COVID crashed financial markets, gold rose. In 2022, when both stocks and bonds fell simultaneously, which almost never happens, gold held its ground. Most financial advisors suggest that a small allocation to gold, somewhere between 5% and 15% of a portfolio, can reduce overall risk without significantly hurting long-term returns. Not because gold will make you rich, but because it tends to move differently from other assets, providing stability when you need it most. How do everyday people actually own gold in 2026? You can buy physical gold, coins or small bars, from reputable dealers. You can buy gold ETFs, funds that track the gold price without requiring you to store anything. And increasingly, you can buy fractional gold through apps, meaning you can start with just a few dollars. The key insight is this: governments can print more money. Companies can issue more shares. But nobody can print more gold. That fixed supply, combined with rising institutional demand and growing global uncertainty, is why the smartest money in the world has been quietly buying it for 3 years running. Gold is not a new idea. It is the oldest store of value in human history. What is new is the scale of institutional buying, the pace of the price rise, and the structural reasons behind it. Reasons that connect directly to everything we have covered in this series. Debt, currency trust, the search for something that holds value when the system is under pressure. Next week on Coin Explained, we are going to talk about the dollar itself, why it rules the world, how it got that power, and what happens if it ever loses it. Hit subscribe and turn on the bell. See you there.